and welcome to this week's session. Lately we have been dealing with a lot of lagging indicators and we have gained a well-rounded understanding of them. It is about time we got into understanding leading indicators, and we'll start with candlestick analysis. The Japanese have been using candlestick charts since the 17th century to analyze rice prices. Candlesticks were introduced into modern technical analysis by Steve Nyssen in his book Japanese Candlestick Charting Techniques.
Candlestick patterns are a form of technical analysis and charting used in all markets. They can be used in all time frames, so they suit day traders, swing trader, and even position trader. The X factor candlesticks have is that they are an amazing tool to use to give market turning points, and when used properly can potentially decrease market risk exposure. Now, you may have heard of some common candlestick chart patterns or candlestick terms like bullish engulfing pattern, doji, dark cloud cover, hammer, and shooting star. We will not be discussing all of them, but we'll explain a couple just to help you understand what you are reading better. There are many important candlestick patterns we do not delve into, and that is really because we do not want to overwhelm you, but rather ease you into understanding all these terms and candles. The UFG team has done an amazing job in making all the technical jargon make sense, and you would be wise to grab yourself a copy of the e-learning course. Believe me, it's gold. Candlestick analysis opens up new and unique tools for technical analysis. But since it's an introduction, we will not provide a trading methodology. For instance, there are many times you would do well to ignore candlestick signals. This is where experience with candlestick charts comes in.
So what are candlesticks?
Japanese candlestick chart analysis, so called because the candlestick lines resemble candles, depict price action in real time. Candlestick charts are easy to understand. The same data required to draw a bar chart, high, low, open and close, is used for a candlestick chart. There are leading indicators. They provide earlier indications of market turning points. And candlestick charts can send out reversal signals in a few sessions rather than the weeks often needed for a bar chart reversal signal. Thus, market turns with candlestick charts will frequently be in advance of traditional indicators. This will help you to enter and exit the market with better timing. Candlestick charts not only show the trend of the move, as does a bar chart, but unlike bar charts, candlestick charts also show the force underpinning the move. Any Western technical tool you now use can also be used in a candlestick chart. Candlestick charts will give you timing and trading benefits not available with bar charts. This merging of Eastern and Western analysis will give you a jump on those who only use the traditional Western charting techniques. They can be used in all markets, such as the stock market, forex market, or futures or commodity markets, and can be a powerful trading tool for option trading. The advantage of candlestick charts is the ability to highlight trend weakness and reversal signals that may not be apparent on a normal bar chart.
Let's break the construction of the candlestick down. The broadest part of the candlestick line is the real body. It represents the range between the session's open and close. Candlesticks contain the same data as a normal bar chart but highlight the relationship between the opening and closing prices. The narrow stick represents the range of prices traded during the period, high to low, while the broad midsection represents the opening and closing prices for the period. If the close is lower than the open, the real body is black. The real body is white if the close is higher than the open. For our trading template, however, we have changed the white candles to blue and the black candles to red. We did this because of the relationship between the colors and the price movement that is clearly seen on MetaTrader 4. Here in the Market Watch, we can see that whenever a price rises, it turns blue, and whenever it falls, it turns red. From this, we conclude that upward movement can be represented by blue and downward movement by red. Blue is also associated with buying, as we can see here in the new order window, while red is associated with selling. The thin lines above and below the real body are called the shadows, sometimes called candlestick wicks. The peak of the upper shadow is the high of the session, and the bottom of the low shadow is the low of the session. The color and length of the real body reveals whether the bulls or the bears are in charge. Note that the candlestick chart lines use the same data as a bar chart: the open, the high, the low, and close. Thus, all Western charting techniques can be integrated with candlestick chart analysis. A critical and powerful advantage of candlestick charts is that the size and color of the real body can send out volumes of information. The shadow is the portion of the trading range outside of the body. We often refer to a candlestick as having a tall shadow or a long tail. A tall shadow indicates resistance, and a long tail signals support. For example, a long blue real body visually displays the bulls are in charge. A long red real body signifies the bears are in control. A small real body, blue or red, indicates a period in which the bulls and the bears are in a tug of war and warns the market's trend may be losing momentum. As the real body gets smaller, we ultimately wind up with a doji, which is a candlestick line which has an equal open and close, and thus no real body.
The doji is a powerful candlestick formation, signifying indecision between bulls and bears. A doji is quite often at the bottom and top of trends, and thus is considered as a sign of possible reversal of price direction. But the doji can be viewed as a continuation pattern as well. A doji is formed when the opening price and the closing price are equal. A long-legged doji, often called a rickshaw man, is the same as the doji, except the upper and lower shadows are much longer than the regular doji formation. Now there are three variations of the doji that we need to learn about. Doji star, including long-legged doji, gravestone doji, and the dragonfly doji. The creation of the doji star pattern illustrates why the doji represents such indecision. After the open, bulls push prices higher only for prices to be rejected and pushed lower by the bears. However, bears are unable to keep prices lower, and the bulls then push prices back into the opening price. Of course, a doji could be formed by prices moving lower first and then higher second. Nevertheless, either way, the market closes back where the session started. The gravestone doji is a significant bearish reversal candlestick pattern that mainly occurs at the top of uptrends. The gravestone doji is created when the open, low, and close are the same or about the same price, where the open, low, and close price are exactly the same price, and this is quite rare. The most important part of the gravestone doji is the long upper shadow. The long upper shadow is generally interpreted by technicians as a meaning that the market is testing to find where supply and potential resistance is located. The construction of the gravestone doji pattern occurs when bulls are able to press prices upwards. However, an area of resistance is found at the high of the session, and selling pressure is able to push prices back down to the opening price. Therefore, the bullish advance upward was entirely rejected by the bears.
The dragonfly occurs when the open and close are near the top of a candlestick and signals reversal after a downward trend. Control has shifted from sellers to buyers. The dragonfly doji is created when the open, high, and close are the same or about the same price, because where the open, high, and close are exactly the same price is quite rare. The most important part of the dragonfly doji is the long lower shadow. The long tail implies that the market tested to find where demand was located and found it. Bears were able to press prices downward, but an area of support was found at the low of the session, and buying pressure was able to push prices back up to the opening price. Thus, the bearish advance downward was entirely rejected by the bulls. The dragonfly doji is an extremely helpful candlestick pattern to help traders visually see where support and demand is located.
The hammer candlestick formation is a significant bullish reversal candlestick pattern that mainly occurs at the bottom of downtrends. The hammer formation is created when the open, high, and close are roughly the same price. Also, there is a long lower shadow, twice the length as the real body. When the high and the close are the same, a bullish hammer candlestick is formed and is considered a stronger formation because the bulls were able to reject the bears completely. Plus, the bulls were able to push price even more past the opening price. In contrast, when the open and high are the same, this hammer formation is considered less bullish, but nevertheless bullish. The bulls were able to counteract the bears, but were not able to bring the price back to the price at the open. The long lower shadow of the hammer implies that the market tested to find where support and demand was located. When the market found the area of support, the lows of the session, bulls began to push prices higher, near the opening price. Thus, the bearish advance downward was rejected by the bulls.
The bearish version of the hammer is the hanging man formation. The inverted hammer candlestick formation occurs mainly at the bottom of downtrends and is a warning of a potential reversal upward. It is important to note that the inverted pattern is a warning of potential price change, not a signal in and of itself to buy. The inverted hammer formation is created when the open, low, and close are roughly the same price. Also, there is a long upper shadow, which should be at least twice the length of the real body. When the low and the open are the same, a bullish inverted hammer candlestick is formed, and it is considered a strong bullish sign that when the low and close are the same, forming a bearish hanging man. The bearish hanging man is still considered bullish, just not as much because the session ended by closing with losses.
The hanging man candlestick formation, as one could predict from the name, is a bearish sign. This pattern occurs mainly at the top of uptrends and is a warning of a potential reversal downward. It is important to emphasize that the hanging man pattern is a warning of potential price change, not a signal in and of itself to go short. The hanging man formation, just like the hammer, is created when the open, high, and close are roughly the same price. Also, there is a long lower shadow, which should be at least twice the length of the real body. When the high and the opening are the same, a bearish hanging man candlestick is formed and is considered a stronger bearish sign than when the high and close are the same, forming a bullish hanging man. The bullish hanging man is still bearish, just less so because the session closed with gains. After a long uptrend, the formation of a hanging man is bearish because prices hesitated by dropping significantly during the session. Granted, buyers came back into the stock, future or currency and pushed the price back near the open, but the fact that prices were able to fall significantly shows that bears are testing the resolve of the bulls. The shooting star candlestick formation is a significant bearish reversal candlestick pattern that mainly occurs at the top of uptrends. The shooting formation is created when the open, low, and close are roughly the same price. Also, there is a long upper shadow, generally defined as at least twice the length of the real body. When the low and the close are the same, a bearish shooting star candlestick is formed, and it is considered a stronger formation because the bears were able to reject the bulls completely. Plus, bears were able to push prices even more by closing below the opening price. The shooting star formation is considered less bearish, but nevertheless bearish, when the opening and low are roughly the same. The bears are able to counteract the bulls, but were not able to bring the price back to the price at the open. The long upper shadow of the shooting star implies that the market tested to find where resistance and supply was located. When the market found the area of resistance, the highs of the session, bears began to push prices lower, ending the session near the opening price. Thus, the bullish advance upward was rejected by the bears.
The long white line is a sign that buyers are firmly in control, a bullish candlestick. A long black line shows that sellers are in control, definitely bearish. Mariposa are often stronger bull or bear signals than long lines, as they show that buyers or sellers have remained in control from the open to the close. There are no intra-period retracements.
In Japanese, morobozu means close cropped or close cut. Bald or shaven head are more commonly used in candlestick analysis. Its meaning reflects the fact that there are no shadows extending from either end of the body. It's quite rare to see a perfect morobozu, as normally there are ever so slight tails. It's the concept that is important. The white morobozu is a long white body with no shadows on either end. This is an extremely strong pattern. Consider how it is formed. It opens on the low and immediately heads up. It continues upward until it closes on its high. Counter to the black morobozu, it is often the first part of a bullish continuation pattern or bearish reversal pattern.
A long black body with no shadows at either end is known as a black morobozu. In this case, it would be red. It is considered a weak indicator. It is often identified in a bearish continuation or bullish reversal pattern, especially if it occurs during a downward trend. A long black candle could represent the final sell-off, making it an alert to a bullish reversal setup.
A closing morobozu has no shadow at its closing end. In both cases, there are strong signals corresponding to the direction that they each represent. A blue body will not have a shadow at the top. A red body will not have a shadow at the bottom.
The opening morobozu has no shadows extending from the opening price end of the body. A blue body will not have a shadow at the bottom end, and a red candle will not have a shadow at its top end. Though these are strong signals, they are not as strong as the closing morobozu.
Spinning tops are depicted as small bodies relative to the shadows. This demonstrates some indecision on the part of bulls and bears. They are considered neutral when trading in a sideways market. However, in a trending or oscillating market, a relatively good rule of thumb is that the next session's trading will probably move in the direction of the opening price. The size of the shadow is not as important as the size of the body for forming a spinning top.
With candlestick charts, one can use candlestick charting techniques or Western techniques, or a combination of both. This union of Eastern and Western techniques provides you with uniquely effective tools to help enhance profits and decrease market risk exposure. While candlesticks may offer useful pointers as to short-term direction, trading on the strength of candlestick signals alone is not advisable.